How's it going, everyone? Welcome back to another dividend investing video. The banking failures with SVB and Signature Bank recently have sent a lot of otherwise solid stocks tumbling, creating some wonderful opportunities for long-term dividend growth investors. I've recently come across some stocks in particular that I think look attractive in terms of locking in a better starting yield and a larger prospect for massive upside for those who can stand to be patient. Remembering that crisis creates opportunity in the long term, I've even opened a position into one of these stocks the other day, and I'm excited to share that with you guys. So let's get into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. The common theme with the stocks on this list is they're in the financial sector, which has been hit the hardest over the last month. Let's look at the Vanguard Financial Index ETF, ticker VFH. This tracks the entire U.S. financial sector weighted by market cap. This fund is down 14% over the last month, and if I was someone looking to profit off this entire sector in a long-term swing trade, I think buying this ETF could make some sense. Pretty decent risk-reward proposition if you ask me. If you could hold on to this for a few years, it could be a pretty bumpy ride. Of course, we don't know what the next couple years could bring. Now let's peek at this fund's top 10 holdings. This fund holds 379 stocks, but the top 10 make up 40% of the entire fund. So therefore, 40% of the financial sector as a whole. Starting at the top, we have JP Morgan Chase, ticker JPM. The largest bank in the world by market cap, making up almost 9% of this ETF, followed by Berkshire Hathaway, which is also massive. Then we have Bank of America, Wells Fargo, Morgan Stanley, Goldman Sachs, S&P Global, Charles Schwab, American Express, and BlackRock, Inc. These are the top 10 largest publicly traded financial companies on the U.S. market. Most of these stocks have been hit pretty hard, and yeah, if you aren't trying to pick a winner and want to just make a profit, this ETF is interesting. Not really my thing, but I can see why some might be buying this ETF right now, and you are getting a 2.5% yield while you wait, and an expense ratio of 0.1%, which is next to nothing. That's a pretty decent hedge. But today we're highlighting what I see as 3 of the best opportunities in this sector, and I see these as great long-term dividend holds. I think there's a ton of upside potential in the next couple years as well. These are stocks near their 52-week lows. They pay hefty dividends with a track record of growing these dividends, and they look solid in terms of valuation. Stick around until the end, so we'll briefly discuss one additional bonus pick that, while I think is a tad riskier than the other 3, looks like a solid opportunity. And one more thing I want to mention real quick is the deal Seeking Alpha has generously made available to our viewers. I use this site in much of my research and for the presentations in my videos. And while I do have a wealth of this information for free, if you wanted to get the benefits of a premium membership, you just click on that link in my description where you can get your first year of Seeking Alpha Premium for only $99. This comes out to just over $8 per month, and I think access to the articles by all these great authors on their site alone makes that worthwhile. And it's a great way you could support the work on our channel. Stock number 1 is Raymond James Financial, ticker RJF. Raymond James Financial is a diversified financial services company that provides private client group, capital markets, asset management, and other services to individuals, corporations, and municipalities in the US, Canada, and Europe. It was founded in 1962 by St. Petersburg broker Robert James, and soon after merged with Raymond and Associates to form Raymond James and Associates. Since that time, they've grown into one of the largest banking institutions in the United States. Their primary business is in investment and financial planning. As of September 30th, 2022, Raymond James has about 8,700 financial advisors, approximately $1.1 trillion in assets under management. Assets under management just means the total value of all their financial assets under control, such as their mutual funds. Now, year-to-date, shares of Raymond James Financial are down over 15% and have dropped 20% in the last month, and currently shares are sitting close to their 52-week low. Raymond James is trading at a PE of 8.8 at the time of publishing, and this is nearly 30% discount to its 5-year average of 12.4. It's also below the sector median PE of 9.2. Shares of Raymond James Financial are yielding about 1.88%. This is 23% above its 5-year average of 1.52%. How about that for a yield that is beating the market? The qualified dividend is paid out quarterly in the months of January, April, July, October, in the amount of 42 cents per share for a total annual payout of $1.68. And if you have your shares of RJF by March 31st, you'll be receiving the next dividend payment on April 17th. The dividend currently makes up 17% of forward earnings, and I love how this company keeps this payout ratio consistently low, leaving plenty of room for it to grow. Simply Safe Dividends gives us a safety score of 99. They see this as about as safe as it gets in the sector, an ironclad dividend from this point of view. Now, the latest dividend raise was announced back in December at 24%, giving Raymond James Financial an average dividend growth rate of 18% over the last 5 years. We have 10 years of consecutive dividend raises and 32 years of paying uninterrupted dividends without a reduction. And shares outstanding are more or less flat over the last decade, not declining, actually up slightly, but no serious dilution or anything concerning. Especially when you consider this company has more than doubled its revenue over the last decade. In 2013, they brought in $4.48 billion in sales, when last year they did nearly $11 billion in sales. Raymond James Financial is a company that has more cash on its balance sheet than it does debt, which is typical for an investment banker. In this last recession, the dividend was maintained, while so many others in the sector suffered cuts. Wall Street analysts give RJF an average rating of 3.91 out of 5, a buy. Out of 12 analysts, 4 rated a strong buy, 3 a buy, and 5 a hold. The average analyst price target is $124.05. There's a potential for 38% upside on Raymond James Financial shares. Now, Raymond James Financial doesn't get a whole lot of attention on FinTwit or dividend circles, but a closer look at this investment banker with 32 years of dividend payments shows a lot to like, and I think deserves a spot on your watch list. Stock number 2 is Bank of America, ticker BAC. Based in Charlotte, North Carolina, Bank of America is the second largest bank in the world by market cap after JP Morgan Chase. It's considered one of the quote-unquote Big Four, along with Chase, Wells Fargo, and Citigroup. According to latest stats, Bank of America receives about 11% of all American bank deposits. They have the consumer banking segment with traditional checking, savings, and money market accounts, credit cards, mortgages, and home equity loans. They also operate a global wealth and investment management segment with brokerage and wealth management services. They also have a global banking segment which provides commercial lending services as well as asset management. This company is massive at a $228 billion market cap. Get this, there's over 15,900 Bank of America ATMs all over the United States. Year-to-date, shares of Bank of America are down 13%, and they've dropped 18% in just the last month. Over the last year, shares of Bank of America are down 32%, and today's shares are trading quite close to that 52-week low. From a valuation standpoint, Bank of America is trading quite low with a PE of 8.3, which is 27% below its 5-year average of 11.3. Bank of America has not looked this attractive valuation-wise in over 3 years. Their valuation is also at a bit of a discount to the financial sector median of 9.1. Today, shares of Bank of America are yielding at just about 3%, and this is 40% above its 5-year average dividend yield of 2.17%. This is the first time we've been able to get a starting yield of 3% since late 2020. Now, the quarterly dividend payment is made in the months of March, June, September, and December in the amount of 22 cents per share for a total annual payout of 88 cents annually. Bank of America's dividend makes up 25% of forward earnings, and we want to see this below 40% for banks. Bank of America's dividend looks to be in a solid position. The Simply Safe Dividend safety score for Bank of America is 55, considered borderline safe. Now, Simply Safe has tougher grading guidelines for banks, in large part, I believe, due to the fact that they're subject to stricter than average regulations by the U.S. government concerning things like dividend payments and share buybacks. And like all major banks, Bank of America did cut its dividend in the last recession. And it's important to note that the dividend payment is still nowhere near what it was in 2007. But over the last 5 years, the dividend has grown at an impressive rate of 70% on average over the last 5 years. The latest raise was not as impressive, at around 5% last June, but note that competitor JP Morgan has not raised its dividend payment in 6 quarters as it has regulations to meet, something CEO Jamie Dimon has hinted at during congressional testimony last year. Bank of America has reduced its shares outstanding by about 29% over the last decade, with 11.5 billion shares outstanding in 2013 to the current amount of shares outstanding at 8.17 billion. And we prefer a declining share count like this as this increases the values of shares we own as investors. The Wall Street analysts ranked Bank of America at 3.65 out of 5, a buy. Out of 26 analysts, 6 rated a strong buy, 7 a buy, 11 a hold, and 2 a sell. The average analyst price target is $40.13, representing over 38% potential upside from current levels. That's some serious potential upside with Bank of America. I think right now I'm picking Bank of America over JP Morgan Chase. Both are fine banks. But from a valuation standpoint, Bank of America is looking a little more attractive. While both of these companies can be gotten for that same 3% yield right now, That's a high yield for Bank of America, while it's fairly average for JP Morgan, suggesting that Bank of America is probably the more attractive pick for dividend growth investors right now. But I wouldn't argue with owning either bank. I own JP Morgan, and as of Friday, I've gotten back into Bank of America when I purchased my first 4 shares last Friday. Hey, I was even mocked for only buying $100 worth of a stock on Twitter by some trader asshole who obviously has a way different strategy than mine. But look, I had to sell this in my divorce a couple years back. I did make a good profit on it at least, and it's finally come back down to my buy range, which is the 3% starting yield. And when it's in that range, I'll continue to add to Bank of America. But I know my strategy personally isn't for everyone. Stock number 3, Prudential Financial Inc., ticker PRU. Founded in 1875 and headquartered in Newark, New Jersey, Prudential is an American company whose subsidiaries provide insurance, retirement planning, investment management, and other products and services to both retail and institutional customers in over 40 countries. Year-to-date shares are down 17% for Prudential and 20% in the last month. At the time of publishing, we are right around that 52-week low, just as we are with the other stocks. Looking at Prudential's PE ratio, they're trading at a 6.7 PE. This is a 16% discount to its 5-year average PE of 8. It's also significantly cheaper than the sector as a whole. Prudential is a nice income stock. Its average yield over the last 5 years has been 4.5%. But check it out. Today you can get your shares of Prudential at a starting yield of over 6%. This is 37% above that 5-year average, making this an intriguing time to potentially buy this stock. Prudential pays its qualified dividend and quarterly payments in the months of March, June, September, and December in the amount of $1.25 per share for a total annual payout of even $5 per share. The dividend makes up 41% of forward earnings, putting it below the ideal max of 50% for insurers. The trailing 12 months earnings payout ratio is a tad above that mark, but this isn't too concerning. There is an overall trend of the payout ratio rising over the last decade. Now, Simply Safe Dividends assigns a safety score of 75, which is rated safe. Prudential has been raising this dividend for 14 years straight. There was a cut during the recession of 2008, but it quickly recovered, and we're looking at a dividend that has grown at double-digit rates ever since that time, aside from its latest increase last month, which was just over 4%. I think the lower raise was expected given these shaky financial times. Now, in addition to the generous dividend, shareholders are also getting the benefit of consistent buybacks. There were 465 million shares outstanding in 2013, and today there are 372 million shares outstanding. This is a 20% reduction in overall shares outstanding in the last decade. Wall Street analysts rate the stock a hold overall. Out of 17 analysts, 1 rates it a strong buy, 12 a hold, and 3 a sell. We have an average analyst price target of $102.27, representing almost 25% upside from where it is today. And this is a stock with a 6% yield, so that's a 31% potential upside in the next year. Now, if you're looking to expand your portfolio with an insurance provider, I think Prudential is one of the best, and at this time, they are certainly one of the most attractively valued. You have a nice income stock with double-digit dividend growth, and it looks like there's a lot of potential upside whenever things do turn around. Perfect for investors who want to collect a 6% yield in the meantime. That is for the patient investor who can handle some volatility. Let's talk about that bonus pick I promised you guys we were going to have. We're taking a look at Charles Schwab, ticker SCHW. They are the broker of everyone's favorite dividend ETF, SCHD, and it's also where I have my own Roth IRA, so I do use this company as a broker, and I'm pretty happy with them. In the last month, shares of SCHW are down almost 30%, and that's even after it came back up from that low of $45 on March 13th. This is going to be definitely more volatile than the other stocks we've discussed. 50% of Schwab's revenue comes from net interest earned by investing clients' cash into safe long-term securities like U.S. Treasuries. And this allows them to offer their services at low to no cost for its customers. That's why we don't have transaction fees when we're buying stock. But the concern is the length of time on the longer-dated securities when a client's cash could be moved at any time. And with interest rates rising over the last year, hurting the value of some of these longer-term bonds, Schwab saw their gross unrealized loss balloon from $4.9 billion in 2021 to $27.9 billion at the end of 2022. But the good news is 80% of the firm's bank deposits fall within the FDIC insurance limits. This isn't nearly as risky as looking at some of those regional banks we talked about in the weekly recap video for the week of March 17th, when we highlighted why some regional banks are on shaky ground. But Schwab does share some of the same concerns associated with these banks, only to a lower degree. These concerns caused Simply Safe Dividends to lower their safety score for Charles Schwab from 99 to 80 for a downgrade, but still overall looking like a safe dividend. Schwab checks a lot of the boxes I'm looking for, with the dividend yield being 45% above its 5-year average, while its PE ratio was 25% below its 5-year average. Even though the dividend was maintained, not raised, between 2020 and 2021, Schwab is growing the dividend at an average rate of 21% over the last 5 years, and we have 32 years of uninterrupted dividend payments. So this could be an interesting time to get into Charles Schwab stock, SCHW. Let me know down in the comments if you're buying any of the stocks mentioned in the video today, or if you're buying a stock that you think I should have highlighted today. Could help me come up with an idea for future videos. For sure. I'm going to be keeping an eye on this financial services sector. Things have been pretty crazy over the last month. And thanks for sticking around, my friends. Always do your own due diligence before investing your hard-earned cash. Don't invest money you might need in the next few years to pay your bills. But whatever you do, just keep investing.